Hello, Keith Prather here with another NCM Marine economic update for this month. As we've said in some of the other videos, we're a little bit later than normal this month. There's just a lot going on, and we wanted to capture as much of the latest as we could. But let me start off by showing you what's happening with the index here. Actually, make sure I've got this correct. There we go. Sorry, I started on the wrong page. So the Marine Leading Index is kind of interesting. We've got a surge in April, and I'd love to say that that's because consumers are trying to get ahead of the tariff risk. That's what we typically are hearing in the marketplace as a popular narrative right now. But I don't think that's the case. Marine purchases are long-term purchases. A lot of consumers will make those decisions based on, their job security, what's happening in the stock market, some of those factors. And I think that they're reading a lot of optimism, at least about the next 3, 4, 5 years ahead. Some of it may be tied to what's happening with the budget bill. The budget bill, for those consumers who are savvy and are really paying attention, would set up a low tax environment for the next 4 to 5 years and carry it out to the end of the decade. And a lot of consumers who are really savvy, again, those who are buying maybe some of the upper end boats, a lot of the pleasure cruisers, they're thinking in those terms. The other side of it is even in some of the lower end, fishing boats and some of those units, you see a construction sector and a manufacturing sector that's getting a lot of support from an administration that believes in growth in those two sectors. So as the Trump administration does things to try and fuel U.S. construction and U.S. manufacturing, which is where its core focus is, and trying to really grow and get momentum built in those industries, there's a lot of optimism for those workers. If you're a construction worker right now, you've still got wage growth, averaging somewhere between 4 and 6% a year, way outpacing inflation of, 2.4% right now. And you've got a pretty good environment ahead, and you've got bosses telling you that, basically they need you and you're super important, and they're willing to chase you with wage increases if you start to job jump. And so for those industries, a lot of them are out, buying fishing boats and pleasure boats and, doing a lot of recreational stuff. And so you got a lot of buyers in those categories that are finally finding a little bit of confidence and they're jumping into the market, even with interest rates still pretty high. So anyway, with all that said, we had almost a 7.7% jump month over month. Now, I would just caution you, sometimes we do get data that's an anomaly. And this almost feels like there was something anomalous in the data. We use multiple data points to go into building the NCM Marine Index, and it could be that when we get May and June data in, that we see maybe the government make an adjustment, and that this index may come down a bit because that's a huge jump. But for now, we'll go with it. It's about 12% higher than it was a year ago, so we're seeing a lot of strength, at least in the data up front. The producer price index, then, when we look at this, it's kind of a measure of supply and demand, and it shows typically when the industry is seeing more demand than supply, we see the producer price index move up. And so it's coming off some really low points, as you all know, kind of coming in the end of last year. And then as we jump into this year, we're starting to see it move up a little bit, which is good. We would normally like to see it, back around the 4% annual growth rates. But it's starting to claw back up, which is pretty decent, and it would assume that there's a pretty good demand environment out there. A couple other things. When we look at the retail forecast, this doesn't have as big an impact on the marine sector, but it's worth showing because it helps us understand consumer spending and where the consumer's mindset is. And so it's still showing a pretty good growth rate through July, but then we do get some deceleration. We do see it start to pull back a little bit, as we kind of get into the end of the year. Um, we did see it overall here, though, growing at a fairly steady rate. You see that the growth rate overall, even though it dips a little bit on a historical basis, total retail spending is still going to feel pretty good. And then again, I think in the marine sector, I think specifically you're going to see some strength there. There's still some pent up demand, from people who have kind of waited over the last 2 to 3 years coming out of the pandemic to make purchases. And some of them, I think, are getting to that point where they really want to get outdoors. They really want to go do some things, and they're willing to make that jump and then make those new purchases. So we know, and I reiterated this last month, but I wanted to reiterate it one more time. So if you do anything in the commercial shipbuilding industry, even if you're competing for resources, right? If we're competing for some of the same materials that go into some of it, so the electronics, some of the navigational systems, some of those things that we compete with in the private sector, we've got basically this build out of both Navy and commercial ships that are going to be taking place because the Trump administration is really throwing a national security interest into building out that sector and making sure that we have a very sharp, robust, um, and healthy shipbuilding industry. And so we'll see what happens. It may not hit the recreational, but I am still getting some signals out there that there is some competition for materials, and that could filter into higher prices for the boat building industry in the private sector. We'll just have to watch it. The Fed, as I said in some of the other videos, really getting confusing data right now. GDP for the second quarter is blowing away expectations. And a lot of that's being driven by really solid consumer spending. So right now, Q2 GDP, based on the economic data that we have so far through the quarter, is running right at about 3.8%. Now, realize a lot of that data is only from April. Some of it's from early May. And so as we start to get May and June data in, we believe that that's going to cool off a little bit. We don't think the economy is running maybe as hot as what some of that data is showing early on, but it's still a positive signal because we were only expecting 1% growth for the quarter going into the quarter. So way ahead of expectations, and that's a good signal for the Federal Reserve. The economy is strong. Job growth right now, I've kind of got that note down here. Still good on most measures. The unemployment rate is steady. Job openings are still high. We've got about 7.4 million jobs open in the US. Normal would be about 6 million jobs. So there's still more job openings than there are available workers. So that's good. But we are starting to see hints of layoffs starting to tick up just a little bit. So we're going to have to watch it. That's going to be a developing situation we'll watch over the next 30 to 60 days, but we don't see it there yet. And we also don't see it in the wage growth yet. I talked about it earlier in the video. Remember, wages are still growing at right at 3.8%, almost 3.9%, which is really a hot wage growth rate. If you go back to the decade prior to the pandemic, wage growth usually would average about 2.5%. Inflation was running about 2% at the time. And that was a pretty healthy environment. Right now, we've got wages growing at 3.8%. We've got inflation at 2.4%. That's very healthy. So helps consumer households, helps them dig out of some of their debt and lets them go spend on other things. Lets them take on more household debt, if you will. The other thing we are watching again is the 10-year Treasury for a lot of big ticket purchases like the marine industry. Even at the 5 and the 10-year Treasury, that typically is what we watch more than we watch the Federal Reserve and what the Fed does. And right now, a lot of those Treasury rates are running kind of hot. We see the 10-year Treasury running right at a yield of about 4.4%. And you can typically add about 2 percentage points on top of that or more to get your average mortgage rate or your average long-term borrowing rate for like the marine sector, for instance. So, that's why we still see mortgage rates and we see, higher interest rates at somewhere around 7%. So the Treasury Department hopes they can get that below 4% before the end of the summer, which would bring that borrowing rate down closer to 6%. And that would really free up a lot of the market. I think you'd see even more people coming in and starting to buy. So we'll see what happens. Again, we're all circling July, and we really want to wait and see what we get out of the next 2 weeks and then early in July, because we're supposed to have a wave of these trade deal announcements, just like we got with the UK. We're also going to see maybe the tax bill get signed, which would be a huge boost to the industry. And then possibly we're going to get some corporate tax easing. And so you could see a lot of companies increase wages more, increase hiring if they do see those tax incentives come through. And that would transfer down into more spending and more discretionary spending by those customers. So hopefully it would create more foot traffic, some of the marine dealerships. So we're going to watch for a lot of that. Overall, the economy looks like it's going to do pretty well. Recession risk is kind of off the table at the moment. I will say this, most of the tariff impacts, as I talk to a lot of companies, have not hit us yet. So I do think we need to watch inflation over the next 30 to 60 days to really look and see and confirm that the tariffs really are going to have no impact. Right now, based on data that we got this week, which is the reason why we waited, the consumer price index and the producer price index both came in under expectations. So it showed very little inflation risk. But as I speak to corporate executives who are purchasing products, buying raw materials, importing a lot of products, they are telling me that they were still feasting off of existing inventories that did not have tariffs attached to them. And now, as they get new products in, as they move forward, they're going to have to pass on a lot of those costs to consumers, and that we may start to see those price increases over the next, again, 30, 60, 90 days. So we need to continue to watch it. Just know that for now, we've got decent economic growth signals from data that we have to date, pretty tame inflation, and a pretty decent and stable job market at the moment. So all of that are pretty positive signals for the marine sector. So anyway, I hope you all are doing well. I hope you're ready for, at the time we were recording this, a great Father's Day weekend for those dads out there. And just hope you have some great time with family together. So everybody take care, and we'll talk to you next month. Thanks. Bye-bye.